Hi, everybody. This is Hyperwave. Happy Sunday. And today is going to be really, really interesting and fun. I'm very excited about it. I actually think this may be the best show ever, putting that one out there. We, as you saw by the title, are going to have a bit of a controversial show. This is all going to be Tyler discussing gold, fiat, Bitcoin, what it means, economics. I'll leave it at that. And also, if anyone notices, if I move, I do have a nice temporary tattoo from Caitlin, which is my sister-in-law's niece, and it says "Roar." We had a lot of dino tattoos going on yesterday. It was a lot of fun. So on Roar, I'll switch it to you, Ty. Looking forward to this one.
Great. Thank you very much, Leah. We weren't going to do this today, but I listened to Safadin's interview, and then I tweeted about it saying it's really terrific. Everybody needs to listen to it. It's with Jeff Deist, who's the president of Mises Institute, and he is also the sort of the interviewer correspondent of Mises Radio. And it's fascinating. But Safadin said something at about minute 44 that really made me sit up and take notice. And I'm going to quote to you what he said. I went back 2 or 3 times and made sure I'm not misquoting him. But towards the end of the interview, he was saying, governments are going to keep trying to take down Bitcoin and all of this sort of thing, but he didn't think they would be able to do it. But then he said, quote, the most likely scenario, if you want to kill Bitcoin, is to restore the gold standard, which really made Jeff Deist sit up and take notice, and me too, because then he said, if that occurs, if Bitcoin's role in the world of economics and economic stability and returning to a standard results in the gold standard coming back, Bitcoin will have served a wonderful purpose. And that's what we're going to talk about today, because you've heard me say, and Leah in a couple of our fireside chats, just our general discussions, that I deeply believe that a solution must be found fairly quickly. And I cannot define that. I used the term imminent a week ago or so, saying that the Bitcoin meltdown was beginning, that was going to take it down to the 5,000 level. And somebody on Twitter today said, how do I define imminent? And he used the wrong word. He used eminent instead of imminent. And it's very easy to get those kind of things wrong. MNM is eminent, meaning he's famous. Imminent means something that's about to occur very quickly. And this person was asking me if I was wrong in saying that downturn was imminent because a week has gone by and it has not happened. And I confess I overused that word in that context. And it's very easy to do that sort of thing. Autocorrect, there's so many funny things with autocorrect. Oh, you've got to look at, just Google it and find all the funny examples of what people have said where they didn't mean to say it. I did the same thing on an earlier tweet on my metaphor about the price going down, and this is the captain speaking, return to your seats and put your or buckle up, basically. And I also said we're descending down to 20,000, but 20,000 feet. But I put a dollar sign in front of the 20,000, and somebody questioned me today, and they say, "Wait a second, Bitcoin never got to 20,000." Well, that's not what I meant. I was talking about if you're in an airplane, you usually fly at 35,000 to 40,000 feet. And so when you descend to 20,000, it's either because you're landing or something is wrong. So words are important. And that's why I wanted to be very careful. I think I want everybody, first of all, to read, I haven't really said it yet, but Tone has and Leah has and many, many others. Be sure to read Bitcoin Standard by Safadine. It's just really brilliant. I'm going to give you a couple of other, I think you should have pencil and paper for today, because we're going to go into some philosophical stuff, some economic stuff, and then we're going to look at 4 charts that are going to tie together Bitcoin, the US dollar, and fiat in general, and also gold prices. I'm a big believer that we need some standard. If it's Bitcoin, wonderful. That's what I prefer. I think practically that has not as much chance on the world stage as gold coming back and being accepted. And I'm going to give you the name of a book shortly that talks about that. It was written in 2013. But first, we're going to venture into the world of philosophical thought, the scientific method, and a thing called the dialectic method. And just a brief history. A lot of people think of this thing called dialectic materialism, which Karl Marx and Hegel basically used as the backdrop for the Communist Manifesto in a lot of ways. That's not what we're talking about. We're talking to something that occurred 50 years before Marx ever got a hold of that idea. And it's a thing called the dialectic method. And it's a form of reasoning, but it was argued by the early practitioners that it was actually a form of observing the natural world. And basically, a lot of people said it was Hegel that came up with the idea. That's not true. That's false. In 1781, Immanuel Kant was the first to describe a way of thinking using 2 opposites. One is called the thesis, and its opposite is called the antithesis. But he never went on to add the triad, which is the most important part of the dialectic method. The triad, the dyad that Immanuel Kant talked about was just that, those 2 things, opposites. You come up with a theory, you come up with a thesis, and then you take the opposite stand. And somewhere in between is probably reality. Well, not too long after that, in fact, just 13 years later, the real founder of the term dialectic method included the middle term synthesis. So then you had thesis, antithesis, and synthesis. 2 opposites, and then something in between that is closer to reality. And he basically was saying that every decision goes through that in the corporate world, in the political world, in the philosophical world, in the scientific world. And it's used in a lot of different ways, but that's the beginning point. He then went on 1 year later and he changed the wording a little bit to thetic, Thetic, antithetic, and synthetic, which means exactly the same thing, but it's a much more active way of looking at it. And anything that comes from the synthesis of a thesis and its antithesis is synthetic. And that's basically how the word is used today, synthetic. Synthetic anything. It isn't real because it's not what everybody originally thought it should be, like clothes, cotton. It's something in between, but it's not like wood. It's less than wood, but it's more than cotton. It's synthetic. Okay. Why do I go on and on about that topic? Because we're going to talk about some triads today. We've already named one of them, gold, fiat, and Bitcoin. I look at as a triad where gold came first, but not necessarily other than as a means of payment. And then it evolved in various ways, and then fiat came along centuries ago, not in the Western world, but then was quickly adopted in the Western world. And now we've got this new player on the block, which is this digital thing, this digital currency that nobody can really define very well. But those three things are imminently, with an EM, linked to each other. I suspected that 10 years ago when I started playing around with Bitcoin and watching gold, but I'm going to try to demonstrate it today because of what Saifedean said, that there is a war going on, but one of the players, Bitcoin, is so tiny and insignificant at this point, and is got so many of its own problems fighting within its space. It's it's like I'm not sure what it's like, but I've tried to describe it as Leah has also in her article that just recently came out, the ecosystem we call it, but that's too highfalutin for me, actually. I wish we could come up with another word. But relative to gold and relative to fiat, no one in the world is thinking crypto and Bitcoin except a tiny, tiny minority that talks to themselves more than anyone else. But you've heard me say it. I think it's very, very important. I think it could be a solution to the macro problem we're about to get into. There was a solution to that problem for many, many, many years, which was gold, that then became a standard along with the US dollar in 1944. So let's jump ahead out of the philosophical and run into the 19 teens and 20s just briefly and look at economic theory and an economic triad, which comes in the form of John Maynard Keynes and Keynesianism and deficit spending, and then monetarism, which has to do with the power of the flow of money and the velocity of money to achieve certain things. We're not going to compare them. Just note that to me they're a very important way of looking at things. And then fiat, but not fiat in the form of paper francs or lira or pounds or dollars or yuan, but fiat conceptually as something that can be pegged to something else, such as gold or such as Bitcoin. Fiat can be pegged to Bitcoin. Not now, and probably never, but it can be. And we'll talk about that in just a little bit. But there are those three very different things. And there's many, many other schools of thought. I will throw the von Mises Institute and Austrian economics into the mix along with monetarism and Keynesianism as the final piece. All of them relate to fiat in various ways, but it has to do with how far you will allow your economic system to use credit over and above what is backed by something, either by Bitcoin or by gold or by a basket of commodities, and on and on and on. So another triad is Keynesianism, the Austrian school, and monetarism. They culminate in a war around 1944. As we're getting out of World War II, we have this very important shift in world macroeconomics because of what happened at Bretton Woods, New Hampshire in 1944. There is a book, and if you would write this down, I cannot stress enough how important this book is. It was written in 2013 by Ben with two N's, Benn, Steil, Steil. And the title of it is The Battle of Bretton Woods. John Maynard Keynes, who happened to be the British representative to Bretton Woods in 1944. Harry Dexter White, who happened to be the US representative, and I'll talk about him in just a moment, and the Making of a New World Order. That's the title of the book. The Battle of Bretton Woods, John Maynard Keynes, Harry Dexter White, and the Making of a New World Order. And that's how important that 21-day conference was. It remade the world order. And I've said that over and over again, and then I've referred to the fact that in 1971 it went out the window because Richard Nixon on his own pulled out of it and no longer allowed the guts of it to work. And we're going to take a minute to talk about that. You've heard me talk about it before, but this is going to be important relative to what Saifedean said. And I will hereby formally invite Saifedean to come on Leah and my show and talk this same subject over in detail, because it was just a 2-minute blip and a couple of sentences, but to me, extremely important in understanding Bitcoin's role in this whole picture. So we will try to get that to happen. Okay, from July 1st through July 22nd of 1944, 730 delegates from around the world, but this is important, comma, all of them are allies, attended the conference in Bretton Woods, New Hampshire. 730 from a total of 44 allied nations, and here is a key point, including Russia. Russia was there. Now, going back very quickly to the war talked about by Ben Steil, he used two names in the title of his book, John Maynard Keynes, who I've already talked about, and Harry Dexter White. Well, Harry Dexter White, at the time, you know who John Maynard Keynes was. And he had influenced everything from the 20s until the 40s in terms of economic thought. University of Chicago jumped on board with both feet and have been pretty much there ever since, with some notable exceptions. Brilliant, brilliant school in terms of economics, but was on the Keynesian bandwagon very early, late 20s, early 30s. And the president of University of Chicago actually started using deficit spending as a way of financing the school, one of the first major schools to do that, very controversial at the time. Anyway, The interesting part of this story is Harry Dexter White. And remember, Russia is there at Bretton Woods. It was later found out that the senior U.S. official who worked under the brilliant Hans Morgenthau Jr., who at the time was U.S. Treasury Secretary, was the senior representative at Bretton Woods. So for 21 days, sat there, went head to head with John Maynard Keynes, who hated gold, at least in his original works, and was the one that coined the phrase the barbaric relic, that it didn't have a place in the world financial system. So it was 21 very bad days for John Maynard Keynes, because what happened at the end, where everybody ended up signing, almost everybody ended up signing the agreement that we'll talk about in just a second. Harry Dexter White was found out to be a Russian spy after the fact. Russia did not sign the Bretton Woods Agreement in 1944. And they said it was because it was simply setting up branches of Wall Street. Turned out to be true, but that's a different story. And he died of a heart attack about 3 years after Bretton Woods, he being Harry Dexter White, because he had been found out he'd been passing notes before, during, and after the conference. But he was our representative to that conference. So if it sounds like an intriguing drama, you are absolutely right. The book is brilliant. You will learn a tremendous amount, and I will be shocked if it isn't a major motion picture shortly. Okay, that sets the groundwork for this collision in 1944 between gold, fiat, and the dollar, a collision between Keynesianism, monetarism, and the Austrian school, who loves gold, loved gold, and still loves gold. And the winner of this gargantuan battle that changed the history of economics right up through 1971, which then, because of the antithesis of Bretton Woods, Richard Nixon, started us down this road to fiat, where we still sit today, and has caused all the problems because Keynesianism, even under the gold standard, found a way to cause tremendous deficit spending. And those are the charts we're going to look at, and we'll get into the details of why all this ties together. I'm just laying the groundwork now. To me, it's fascinating, and you need, if you're a Bitcoin maximalist or enthusiast or unbeliever, which is the majority of the world population, to understand all this stuff. It all fits in together. The problems we're having, the problems we had in 2006, 7, and 8, the reaction to the problem of the dot-com with Alan Greenspan beginning to print money by dropping the availability of money's cost down to zero, and the resulting explosion of real estate and mortgages that resulted in the next problem, which caused his successor and that successor's successor, and even today, the third successor's successor, to do the same things because they don't have an alternative. Not an easy one. And in the midst of all of this, right towards the end of it, the last 10 years, you get this new experiment that we're all so excited about, or were excited about until December of 2017. Some of us have not been so excited since that date, but there are still plenty of people that are and should be. Their timing, in my opinion, is just a little bit off. And if what Saifedean said, if that's what he meant, those people might be off by a very, very long time. And that's why I think this discussion is so important. Now, there's two other real quick things, and then we're going to look at some charts and try to pull all this together. This is not going to go on forever. I've taken 30 minutes kind of in the introduction, but I think they're an important introduction into what we're going to be talking about. So, at the time of 1944 Bretton Woods, take a guess at where all the gold in the world was. Knowing what you know, what either you've read about or what we've said, that what came out of Bretton Woods was basically marrying gold and the US dollar and calling them the reserve currencies of the world. Well, 2/3 of all the gold in the world was controlled by the United States in 1944. It's not nearly that high now, but you might be surprised. There's all kinds of misinformation about who owns the gold. And I'm going to just quickly go over that because what we're talking about now is a gold standard. Saifedean called his book the Bitcoin standard. And it was very clear that he used that word because it could be a replacement for the old gold standard. And there's a lot of good reasons why that would happen, might happen, should happen. And there's huge benefits, in my opinion, if that does happen. That's different than the question of what will happen, what should happen, because of the question of what could happen. What's the most practical thing at this point for world economics? Is it yet Bitcoin or is it something else? And again, it was his quote that Bitcoin will have played a very important role in his world of economics and of sound money if it can force world powers back to another Bretton Woods, which comes out with a gold standard, which in my opinion would put off for a very, very long time the success of Bitcoin. And if I'm interpreting what Saifedean said, he believes that also. But I can't put those words into his mouth. That's why we need to get together. Okay, let's talk about gold today, 2017, 2018. The US today has 8,000 tons of gold, which is more than the combination of the next three. In other words, the US has more gold than number 2, 3, and 4 put together. Remember 1944, the US had 2/3 of all the gold in the world. In other words, if the US wanted gold, we were going to get gold. If the US wanted the US dollar out of Bretton Woods, we were going to get the US dollar. Another aside, and Leah will love this part because a lot of people don't realize it. Leah does. But Bretton Woods was also the germination of the IMF and the World Bank. Now just think about this for a second. 21 days is all it took for 730 delegates from 44 countries to set up the World Bank. At the time, it wasn't actually the World Bank. It became the World Bank. It was called the International Bank for Reconstruction and Development, which is now subsumed into the World Bank group. But in any case, the IMF, International Monetary Fund, what became the World Bank, the International Bank for Reconstruction and Development, and a whole new macroeconomic financial system came out of 21 days of work. I believe it can happen again. I believe it is in the works. And I believe under a Trump presidency, it becomes more and more likely. Okay, I want to talk about all that with Safedine too, because he knows, for everything I know about economics, he knows 1,000 times more. And we're not really talking economics. What this is the merger of finance, economics, investing, and this new thing called Bitcoin. So I think it'll be very interesting. Okay, today, 8,000 tons of gold in the US or controlled by the US, more than number 2, 3, and 4 put together. So the next question is, guess who is 2, 3, and 4? Wrong. I was wrong. I would have said China, Russia, and India. And it's not even close. 2, 3, and 4 is Germany, Italy, and France. What you have been hearing about and reading about all of these tales about the Chinese, the Russians, and the Indians is absolutely correct. They are the biggest side of the demand equation for gold. That's different than who controls the most gold. Russia, and this is another thing I didn't realize, for 6 years in a row, ending in 2017, we'll get numbers for 2018 a little bit later. For 6 years in a row through 2017, Russia has been the single largest buyer of gold in the world, followed by China and India. I thought China was far and away the biggest buyer. Now, the rumor is that the Chinese have other ways of buying gold that don't show up in these statistics. And I've tried to track that down for a number of years, and I can't really get close to it. But in any case, this is what sort of everyone agrees, that behind the US is Germany, Italy, France, Russia, and China, and not too far behind that. Now, China was in the number 5 spot until Russia went on this binge. And in the last year, 2017, Russia bought 277 tons of gold, which put it ahead of China for the total amount of gold under control, and China dropped down to number 6. Okay, that's the whole groundwork. Now, let's get to the specifics. I'm going to show you 4 charts. And I can't explain why exactly, but as I go through the charts, it will come to me. So first thing I'm going to do is I'm going to do this and this and that and that. And move this here and make this big. Okay. You are looking at the spot price of gold from 1970 to the present. 1971 is where Nixon closes the gold window, and that kind of starts things off because we're pegged at $35 an ounce, had been since 1944, briefly at $32.50 before that. But so all of this activity starts in 1970. And I just want you to look at the chart and see what happened. This is the 10-year period between when we go off Bretton Woods, and now anyone in the world who has gold can turn it in for dollars, and anyone in the world who has dollars can turn it in for gold. So we will take all comers, all currencies. And what resulted when Nixon closed the gold window is this huge spike that ran up to 200 and some dollars. This is a log scale, which you know I hate, and we're not going to do hyperwave analysis on it, but you had this. This is a run up from $30 to 200 approximately. And then a correction, and we're still only midway through the 1970s. And then this enormous spike from $140 to $800 in 2.5 years. I've talked before about what was going on in the world after Nixon did that relative to gold. And I'm not talking about silver and the Hunt brothers. That's a different story. And they were riding the coattails of the fundamentals of what was going on in gold relative to US dollars. Because the US was running big deficits since 1960. And therefore, everybody knew around the world that dollars were getting worth less and less. So if you had a bunch of dollars, like petrodollars or what were called euro dollars before there was the euro, which meant US dollars that ended up because of a balance of trade over in Europe, the way it has been working with China now for the last 20 years, where they have tons and tons and tons of dollars. And all of a sudden, Richard Nixon won't allow you to convert those at $35 an ounce to gold. What do you think is going to happen to the price of gold? Everybody's going to use those dollars to buy gold, and that's what happened. And there's a great history of what the IMF on the other side of this equation set up by Bretton Woods was trying to do to fight this and keep the price of gold down. What were they doing? They were working hand in hand with the US Treasury, selling gold bullion at auctions. Originally every quarter or two, and then every 6 weeks. They would sell enormous amounts of gold and auction it to anyone in the world, including central banks, but anybody. If you wanted to buy gold, you could, if you had enough money to enter these auctions. So that occurred from 1973 all the way to the peak. And in this big run-up, every time there was an auction, which the players selling the gold were hoping were going to drive down the price of gold, just the opposite happened. The auction would be swamped by buyers that would totally gobble up everything the IMF and the US Treasury was selling. Every time. Every auction, the price was higher than the one before, higher than the one before. Finally, somebody got the memo and they stopped the auctions. Luckily, Paul Volcker came along at this point as the Fed chairman, because by this time, dollars had been inflating to such an extent, and the consumer price index was over 20%, and you could get over 20% in a money market fund at a bank. And the Federal Reserve under Volcker said enough is enough, and he forced the price of US Treasury bonds, which we are going to take a look at in just a minute, up to 15.5%. You could buy a US 30-year Treasury bond, hold it for 30 years, get paid 15.5% per year, and get all your money back at the end, 30 years later. Well, that killed business in the US, because the opposite side of a saver getting those kind of returns is a borrower having to pay those kind of returns, like a business or a mortgage or a car loan, or on and on and on. So Paul Volcker, decided he was going to force the issue, kill inflation, and that began the tremendous rise in bond prices and the fall in interest rates, which is the next chart we will look at. Look at what happened here. Okay, so gold peaks at 880 and then comes all the way back down to 250 bucks. But look how long it took. 1980 to 2000. Didn't really get going to 2001, 2002. And then it doubles in price from its old high, which was $880, got all the way up to 1900, more than doubled in price until this recent pullback. But I want you to look at the lengths of time that macroeconomics plays out and absorb some of the political, economic, financial effects of these macro changes. Okay, so that's the gold chart. Now I'm going to interpose the dollar chart, which you've seen me bring up again, but not in this context. Because we're talking, remember, gold, Bitcoin, and fiat. This is one form of fiat, the US dollar. There's a lot of strange looking things on this chart to me. Because everybody's been saying, well, the dollar's been falling 95% since World War II. But you look at this chart that starts in 1971, and you see from 1977 until 1980, when Paul Volcker got an itchy trigger finger, what happened to the US dollar. It ran from approximately 85, where it is now, between 85 and 90, here, all the way up to $165. $165. So it doubled. The value of the dollar doubled, according to this chart, which is very misleading. And that's why I want to talk about fiat a little bit differently than everyone thinks about it. Yes, it's true. This is a chart of $100 bills, but what's it telling you? It's paper money. It's backed by nothing except the taxing ability of the U.S. government, basically, and their promise, meaning the U.S. government's promise that they will pay it back if you turn it in. You can turn in $100. You can't get gold for it, but you can get two $50 bills. Or back then, you could even still get silver in half dollars. That changed in 1974. But what I'm saying is the full faith and credit of the U.S. government. But what's it measuring? It's measuring its relationship to all the other currencies in the world. It is not measuring its ability to buy things. Those are two very different but important concepts in the context of discussing Bitcoin. The US dollar, basically in the mid-70s, is trading relative to a basket of other currencies at the same level. In between, it's gone way up, way down, way up, way down, recently kind of up, relative to a basket of currencies, not relative to things that you and I buy every day. So to understand that, we need to look at this chart. This is a chart of the price of things in the US relative to dollars. This is what everybody has in their mind when they talk about fiat money getting more and more worthless all the time. It's not that it's more and more worthless relative to other countries' currencies, which plays a big role in trade, imports and exports, or travel. Leah and the crowd are getting excited about going over to Europe because the dollar's been relatively strong compared to the euro. That's a different way of looking at currencies. It simply means when we're going up that we're the best of everybody else. And when we're going down, we are the worst or close to being the worst of everybody else. And so on and so on. And what's the determining factor between what a dollar can buy? And I've used this over and over again. The dollar buys 95% less than it did in World War II. It's dropped 95% of its value. That doesn't show up on this chart. It does, however, show up on this chart. This is the buying power of those dollars. Now, because we are sitting right about where the dollar was when that first chart we looked at, and the dollar's gone way up and way down and way up and way down, and now we're right back where we are. What does that mean about all the other world currencies? They've done the same thing because of this chart. If we were the only ones that had a chart like this in terms of our prices, then the chart of the US dollar would have been going down over that entire period. And we just looked at it and it has not. In fact, it's exactly where it was at the beginning. And the beginning of it was right around here. And look what its buying power has done since 1974. It's down, I'm going to just come over here to the scale and let's call it 40. It's gone from 40 to 250, or a lot. That's as mathematical as I want to get at this point. In other words, prices are rising much quicker than the GDP and corporations are able to offset. If corporations' earnings are greater than the decline in the dollar relative to what it can buy, then corporations can go up in value because they are arbitraging the speed with which producer and consumer prices are going up with how fast their earnings are going up to offset that differential. The US cannot do it. No other country can do it with their fiat money because they don't produce anything. There's no production. There are no services. They take money from their constituencies and then they give it back to them in various amounts depending on which buckets you're in. It produces nothing, as opposed to a corporation or a service that does and therefore can continue to grow. The only thing that's continuing to grow in this equation is the dollar's inability to keep buying things at the levels that it was. And that is totally masked, totally, in conversations by politicians, in conversations by economists, and definitely by the media, because of this one simple realization of we're not talking about US dollars. We're talking about US dollars in relation to what they can buy in this country. Okay. And then the last one I wanted to show you, you have seen before, because here is Bretton Woods, right over here. This is what happened after Bretton Woods until 1970 for the yields on 30-year US Treasury bonds. So we got to think about this now. And this is what's happened since Paul Volcker killed inflation by artificially raising interest rates to a point that put us into 2 deep recessions and killed off inflation at this point. And this is the result of the last 40 years. This is the first 40 years. Yes, this is a hyperwave, the biggest one I've ever seen. This is the first 40 years, and this is the last 40 years. And the difference between the two is the inflation of the dollar being able to buy less and less, and then the reduction of interest rates and economic activity to the extent that inflation was lower than GDP, a lot lower than corporate profits, and could also stabilize our fiat money. So the problem that I see in the statement that Saifuddin said, and that I believe is true, is, I'm going to get back off this. So, okay, so I'm going to just go boom, bada, and then boom, bada. Okay. Okay, so those are the 4 charts, and they intermingle. I didn't bring up a Bitcoin chart because you've seen it every day. You know exactly where it is and what it's doing, and the fact that it had a 10-year bull market marked by 3 boom and bust cycles. We're in the 3rd one, and there's all kinds of interesting interpretations of where we are and where we're going and all that. But I want to get beyond all of that. I want to get to the essence of the economic argument, which is, I have thought for 10 years, I went through 07 through 09, and I went through 00 through 03, managing in the latter case, billions of dollars for institutions and individuals, and had to ride through that 3-year bear market, 2001, 2, and 3. Luckily, I had some tools at my disposal that most people in finance did not have. One of them was Hyperwave, so I was able to protect clients' assets as best I could, knowing where prices were going, prices of things in terms of stocks and bonds and interest rates and all that sort of thing. In 07, 08, 09, I had semi-retired, and I was managing money for a number of friends, family, and old clients that I brought with me after a big credit card company bought the bank where I had been doing all that other work. But I was still responsible for many, many accounts and many millions of dollars for people that I had known for many years. And I saw what was happening, what was coming, and I saw what mortgages were doing, and I knew it was going to be really bad. So we took very defensive action, much more than I could do under the strict guidelines of large institutions, which I had been managing before. And one of the reasons I did all of that was simply because of that reason. I wanted total flexibility the next time around to be able to protect clients' assets, regardless of what trustees and attorneys and CPAs were telling we're telling the clients. Now, the reason I'm giving you that background is because what's about to happen, I don't know if it's a month, I don't know if it's imminent, I don't know if it's a month from now or 6 months from now or a year or 3 years from now, but sometime in the near future, I believe we are facing a crisis that is exponentially larger than '07 through '09. And that is for another day, other than remember that chart of what consumer prices are doing. And remember the chart of 30-year Treasury bonds with yields dropping from 15.5% down to basically zero. And now we're slightly above zero. Short-term interest rates were at 6.5% at the beginning of '06, '07. And so the Federal Reserve could cut from 6% down to zero. Now we're at 1.75%. And the problem is 10 times bigger than it was back then. So the only tools central banks have, and why is the dollar strong right now? The dollar is strong right now because our interest rates and our business activity is higher and better than almost every other country in the world. Therefore, the dollar is going up because you get paid more by sending your money into US bonds and getting 0.5% more than you can in their own country's bonds. Therefore, there is upward pressure on US dollars and downward pressure in extreme cases in Italy and in Turkey, in Venezuela and Argentina, around the world. But it's a small differential. It used to be a big differential between US interest rates and policy and the rest of the world. But still 28% by last count, and that might be off, don't hold me to it. It was 34%. 28% of countries have negative interest rates still. Germany did for a while, the UK did for a while, Japan did for a while, they might still, I'm not sure. But my point is that the currency game is only between currencies and doesn't speak to the safety of any individual currency, the US dollar in particular, when you start looking at other things like debt. And the debt credit problem must be solved. And in my mind, with my background and my experience, before Bitcoin came along, there was only two ways to do it. And I still believe there's only two ways to do it, excluding Bitcoin. One is to default on the debt, meaning you simply, as a country, say, yes, we know we owe you a $500 billion, and that's what our bonds say. We simply cannot keep making the payments on them. We are going to unilaterally renege on those promises by X%. We no longer owe you that money. For people that own treasury bills, treasury bonds, treasury notes. That's one solution here in the United States. It will never happen. Around the edges it will, but around the edges, the problem's way too big. Around the edges won't cut it anymore. It's cut it for 50 years. You can always push it off, push it off, push it off. You can't do that, in my opinion, anymore. So the second thing, and the one that to me has always been the most likely, is going back to a gold standard. What a gold standard does is it forces each individual currency to stay within a certain percentage of a target. And I think we are pretty close to a lot of economists and heads of treasuries and central banks in some form of that coming back. But in the meantime, a third one was just introduced 10 years ago. And theoretically, going back to the thetic and the antithetic and the synthetic, this is somewhere in between governments being unable to control themselves in terms of spending our money, not their money, and some kind of a complete lock on the movement of the underlying gold price as a standard, a gold standard. It was locked at $35, so everything went up and around it. I think this time around it has to be locked at $10,000 an ounce. And so I've been looking very closely at the price of gold and silver for the last 10 years. And what we saw is interesting. I'm very disappointed that we've seen gold turn down, but we caught it early using Consensio. And Consensio, if you think about it for a second, is the dialectic method. It's saying there's two things, a bull market, the thesis, and the antithesis is a bear market. The synthesis of those two things occurs when certain things happen that begin to shift away from the thesis closer and closer to the antithesis. And it can be measured, and it's a terrific way to understand change. Everything from the dialectic materialism of Marx to the dialectic method of Kant and Johann Fichte has to do with change, measuring change, and understanding that at any point in time, a thesis might appear to be correct. At any point in time, Keynesianism made a lot of sense and was a wonderful way of expanding economies until it ran into the realism of the Austrian school that said you're going to go too far and you need a base, a standard. And that's why they are so wedded to the gold standard. But in all of those examples I used, the same thing is going on right now with this debate between Bitcoin. Let's look at Bitcoin with open eyes now. If there was no possibility of getting a gold standard, or if the politics of bringing it back become much more difficult than in 1944 following a devastating war where everybody was looking for any solution they could get and was willing to give as much as they needed to give to allow the strongest nation in the world to take the reins, as long as it had some connection with gold for everybody else. That was a fairly easy deal, and it was done in 21 days. This time around, it ain't easy at all. You've got splinters all over the world, some of them collecting gold as fast as they can, Russia, India, and China. Some of them hanging on to gold for dear life, others being forced out of gold because of their economic situation. They're having to sell it off. Venezuela has sold off an enormous amount of their gold. They have to, because they don't have any reserves, and so on and so on. Then you've got the huge split between the two largest economies in the world, China and the US. And China's been moving methodically but powerfully in terms of weakening the US dollar as a reserve currency, and using not only the yuan, but a basket of commodities, including gold, as some sort of a standard. I don't want to be in that meeting if it occurs where everybody sits down and tries to come to a conclusion. Therefore, Bitcoin had the ability to run thousands of percentage points up on a very small base, but still it did it. And it did it, in my opinion, because of the realization how big the problem is and the possible solutions are not very attractive. And here is one that might be, and I believe will be, if a gold standard isn't brought back. And one way of me measuring that probability is the direction that Bitcoin is going and gold is going. Very interesting. They both moved up together. That tells me that there was a simpatico thinking around the world between something must be done and either gold or Bitcoin sounds reasonable. But look what they're both doing now. They're both going down. Bitcoin for 8 months and losing 70, 75%, 80% of its value. Gold was in a bull market, sort of. We looked at the long-term chart, and now it's rolled over and is going down along with Bitcoin. And what's the dollar doing? It's going up. My reading of that triad between those three is that the US economy, the US dollar, is winning at this point and is recognized as winning at this point, which to me says that the crisis is being pushed off because of the strength of the Trump presidency and the Trump economy and the Trump confidence in the US and corporate confidence in the US. That's a big jump. And I'd love for Saifedean to weigh in on that when we get together. So that's my whole take on this war between gold, Bitcoin, and fiat money. They are interlinked. They have been historically. Bitcoin is the new potential experiment and solution, but it's got a number of problems it's got to overcome. If it can do it and the rest of the world does not buy into the gold scenario, we're going to see much, much higher prices in Bitcoin. And with that, I be finished.
You be finished, Ty. What?
I'd love if we got any questions.
To be honest, this is one of the few times where I was not watching the live chat and was.
That's okay. That's okay.
Yours.
We will take them in writing. But I think it would be a lot of fun if we can get Saifedean on, have this kind of a discussion, and then do a very long question and answer period afterwards. Because
so Tyler, I mean, I can ask questions.
Well, yeah, of course you can.
Oh, thank you for permission. Just kidding. Do you want to repeat what you believe the 5 pillars of Bitcoin to be? And therefore, if you believe that those are still, and if they are superior to the gold standard, if it did come back?
In theory, I think they are. You know, transferability and fungibility and immutability and store of value.
Permissionless value transfer, I believe you said.
Yeah, but it's theoretical up to this point, and Saifedean says the same thing. A lot better than other cryptos, but that's not what we're talking about. We're talking about fiat, gold, and Bitcoin, not crypto. You all know what I think about crypto. Just relative to Bitcoin, it's not in the same ballpark. It can do other things maybe, I don't care if it does other things. That's all noise. This is not noise. Bitcoin, gold, fiat. And gold is much better for most of those things, practically speaking, right up through today, because of all the problems with Bitcoin, not the theory of Bitcoin, not what was proposed in the white paper for Bitcoin, the practicality of where it is, being able to buy it, being able not to be hacked, being able, not to have governments who don't understand it put it into the wrong bucket and regulate it, close down exchanges, put people in jail, close down projects. In the US, we've gotten a pass, Bitcoin's gotten a pass from the SEC, but look what they did. They threw in Ethereum, which just confuses everything, because now